Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Okay, Charles, listen, thanks so much for taking the time just to do a brief overview. You've included a new security in your portfolio, and when we do that, I'd like to just get a bit of a summary from you as to why. What was it that attracted you to the new security that was put in? Why was it put in? And really just have a high-level conversation about that, so that people can get a bit of an understanding as to, in this case, it's the buy side, but then we also do these calls for whenever you sell something. So since we've got a new security in the portfolio, let's just talk a little bit about that.
Okay, Scott. Yes, I added Caterpillar a couple of days ago, and the whole thing is that each day you're perusing the market from day to day, and we're always looking for what we think is a mispriced company in the marketplace, and it could be mispriced from a too high value or mispriced from a discounted value, in our opinion. And when you look closer, you would see, for example, when the market's down, when the housing market went down, of course, they were mispriced on the downside, but you had to be careful that you were buying value or buying companies that would come back. And, of course, it happened with the banks, and it happens in different industries over time. And certainly now when you look at the cyclicals and you look at the industrial stocks, a lot of them are down because there's a perception out there that China's slowing and the economy might falter or it hasn't picked up yet. So we just keep looking around to see if anything interesting comes up. And of course, Caterpillar piqued my attention. One, the quality of the company, of course, is very important, and that goes without saying. And Caterpillar, everyone knows Caterpillar, and it's a global leader in manufacturing construction. And as long as the world continues to become more industrialized, there's plenty demand for Caterpillar products.
And so this is the company that has all those big, massive equipment, the dump trucks and the backhoe type things.
Everything, yeah. And it's a global leader in the machines and the equipment that are required to build the infrastructure needed to support global industrialization. This company is the best-of-breed leader in that industry.
Okay.
So they rely a lot on exports and they do a lot of mining business, construction business, and the power business. So it's a massive company. When we look at it, so the stock is down. We look at from a business point of view, we look at what their competitors are doing, and their competitors would be John Deere and CNH Global and Kubota and a couple of other companies. And when we look at the whole industry is down, but we look at it, we see that Caterpillar is the best of breed in all those businesses. So the other ones are struggling a lot more than Caterpillar is, and the ability of Caterpillar to be able to deliver shareholder value speaks to the quality of the management. So it always comes back to the management's ability to be able to create shareholder value is what we're looking for. So once we decide that it's the business that we understand and the business that we like, usually what happens is when the market misprices them on the downside, it's either because of a total market decline, or number two, there is a headline exposure in the press, or there's something in the industry that might be a bit of a problem. And that just creates an opportunity to go through to see if it really holds true or not, or what the probability factors are of the market being right on the discounting value. So once we did that, we went through it, and the company's a wonderful business and a wonderful company. So we understand that we like the business. Now, it's a very volatile industry and a very volatile company, which is really important for the buy side, especially because volatility is not really a risk factor if you understand what you want and what price you want to pay for the value that you're going to get. So what we like is we like volatile markets and we like volatile companies because it gives us more of an opportunity to buy something that we like. And if we understand what we're paying for it, this is really important. So we love that. So we understand it. We understand the business. So then we look at what the price we have to pay for it. So when we do the quality of earnings and we do the return on invested capital, they're all in the top quintile of all businesses in North America. So they're making money. They have excess free cash flow. It's an extremely high quality business, even with the economy being where it is. And so that gets us to the point, so they're delivering shareholder value, they're creating shareholder value, even in sort of a bad market for that whole cyclical and industrial sector. Then we get down to what the actual value of the company is. What is the market saying about the company, and why would we buy the company here? Well, the stock, we got it was just a couple of days ago, the stock was trading at $84. So as we said before, and we're always looking at this, how we value a business is what the operational value of the business is. And all that is if you take the cash that the company earned in the last 12 quarters, what we want to do, and we divide that by the cost of capital, we want to come up with cash, a non-growth, a no-growth value of the cash that the company created in the last 12 months, which is a very conservative way of analyzing and evaluating a business. So there's no evaluation on the book value. There's no evaluation on what the brand is. It's just what's the cash. So what we do is we use a benchmark of $1. So where is the operational value of all businesses based on $1? When we look at it, the market is saying at $84 that Caterpillar will have a permanent loss of 20% a year. What that's saying is that instead of $1, the benchmark value of $1, we bought Caterpillar at 82 cents. So that's roughly an 18-20% discount to its operational value. So the market is saying that Caterpillar will never grow again. The same as it said that IBM would never grow again because we bought IBM at 97 cents, which was below the operational value. So every time we buy a business, we buy it under what the operational value is. So we don't very often, unless there's a massive market hammer, get the opportunity to buy a quality business under operational value. So we say the market has mispriced this. Well, they're having, the economy's having some problems, and that's fine. We're not market timers, but we buy great businesses, and now we're going to hold on to that business for 1, 2, 3, 4, 5, 6, 8, 10 years. Maybe we would never sell the business, but from a cyclical point of view, I'm sure that we will. The idea is that we understand the value we're getting for the price that we're paying. So we're going to wind up giving it back to the market when the economy picks up more and they're shipping more into the BRIC companies and more into China. That company eventually is going to get overvalued. So we look at maybe selling it back at $160 or $170 or $1.60 or $1.70 when it is very overvalued, when the expectations of the market is a lot higher. So Caterpillar is priced for doom and gloom. Eventually, it'll be overpriced because the expectations are so high about the company because their expansion and they're making money. This is they're the vagaries of the fear and greed aspect of the marketplace.
Yeah. So in essence, then the market is looking at the whole industry and saying this whole industry is not going to go anywhere. And as a result of China maybe not expanding as quickly as expected, whatever the noise is. And so the market just says, I'm going elsewhere. And you know what? This industry is now not just, it doesn't have the forecast, doesn't have the future that that it should have or whatever, for whatever reason, they're just saying it's not worth this. And so the market just, is it safe to say the market is underpricing it? The market
yes,
is
the market, how you make money in the market is we're looking for the market price, the marketplace to misprice some company in our opinion. So they mispriced Apple at $750. Now it's at $400.
Right.
But they just mispriced it on the other side.
Right. So then in this case, you've gone through, done a deep dive and said, okay, for this company to be worth $1, it should be priced, the price of the company should be X. And then you take a look at what the market's looking at it, pricing it at, and say, okay, the market's pricing it when you bought it was around 82, 84 a few days ago. And so the market says, okay, it's worth, well, in that case, it would be 82 cents. 82 cents. And you say, well, wait a minute, it's really worth $1. And the market's saying that it's not going to grow anymore. So that's a false statement because it's the best company in that.
No, it's a false statement because we're looking at the cash the company generates.
Yeah, yeah.
So when you look at the non-growth part of the cash, so anything under $1, the market says will never grow again.
Right.
But the company grows.
But the company grows, exactly. So.
But now they're giving it a 20%, well, 18 to 20% discount on an operational cash basis.
Right, right.
Which is ridiculous. But what gives us the ability to do this is the reconciling the gap accounting with the economics of business. So when we do the deep dive and we go in there and we look at the cash and everything, we know exactly what the business is worth. In fact, if John Deere or Kabuto or some other company, if they could and had the opportunity, they would love to take Caterpillar private at this price.
Right. Because
it's such a discount. Because they know that the growth is going to come a lot higher as the economy picks up because it's the best breed business. But they can't take the company private because of the shareholder kind of thing. But from a technical point of view, you could.
Right. So you've gone in, you recognize, you found a company which you love, and then just put it on your wish list and said, well, whenever this company gets to a point that the market's mispriced it on the downside, then that would be worth buying. You've identified now that has happened. You then picked it up for your portfolios a handful of days ago. And so now why?
When it was $116, $118, then I don't want it.
Yeah. So now, as a result of that, it's been a very short period of time, and then there's been this kind of pop that's happened because since you bought it, it's up about 7 or 8%. And so I don't know.
Yeah, it's up even more now.
So any reason for why that was?
Here's the reason why that happened. There is no reason.
Yeah, okay.
And there is no reason because this is one of the fallacies of the marketplace. You buy something, it goes up, and this is a psychological aspect. Then you start reinforcing and justifying why you bought it. Now you start thinking you really know something and you're smart. I bought it at $84, and if it went to $104 and 2 days later, people say I'm smart. It's got nothing to do with me. The same as if I bought it at $84 and it went to $80 the next day. It has nothing to do with me. We're not buying for short term. We're buying the process because we feel that it is undervalued.
Yeah, and that makes sense.
If the market jumps one day or whatever, what if somebody took the company over, which happens a lot in the portfolio, companies get taken out, then it looks like you're a genius.
Right.
And I say, no, I'm not a genius. What we're trying to do is identify value at a really great price, and then we're holding those businesses. And then whatever happens is basically luck after that because it has nothing to do with me controlling results.
Right.
But what we want to do is always put ourselves in a position where we have margin of safety. That once we're in the margin of safety, okay, now let's see what you can do. But it's not because I'm smart or I'm a market timer or anything. It's quite the opposite. So we do not pay any attention from a psychological point that we're smart.
Right. So what you can control is the process, and this is the process that you've gone through that's identified the company as, an attractive company, a great company in an industry that has pulled back a little bit. The deep dive tells us that you can pick up this company for 82 cents on the dollar. You buy that company because it's the right time to buy. Plain and simple. Whatever happens beyond that is what happens.
Exactly. We don't know the top or the bottom of anything. So it's not too early and it's not too late. What it is, we identify 18 to 20% discount for Caterpillar is really great. But I don't know whether that we could go to 80 cents or 75 cents or even 70. The only thing that I do know is to buy really good best in breed businesses, you don't get to steal them all the time. So for it to go to 75 cents, that would be a little extreme.
Yeah.
But maybe we get a market hammering here because something happens, say in the overall market, some disaster or something might happen, could actually on a short-term basis push Caterpillar down to 75. But if it did, would we be happy or sad? We would be happy because now we got a better deal.
Right.
So that's why when we look at the negative aspect of the market, all we're trying to do is look for mispricing. So whatever happens in the market, if we understand the price we pay for the value, the more trouble in the market, the more value it is for us, because we're not in it for 1 or 2 or 10 days or even a year. We don't care, but we know that the value will be perceived in the marketplace, and then it will become overvalued, and then we will be selling it back to those people. We will sell it to the people that are selling it to us now.
Right. Well, I love the process. It's a process you just can't argue with. When you can find the companies, which seems to be the challenging part, but when you can find those companies that meet the criteria in the process, and then you just simply execute based on the process.
And it shows you that the market is inefficient, because if you did a deep dive, if you actually work for Caterpillar, or you're in the industry and you are really aware of the values of the companies in that industry, you think that the people that own Caterpillar, the people that were their competitors, or the real sharp people that understood the industries, think that Caterpillar's a sale at 82 cents when the operational value is $1? They're looking at it and saying, God, would we ever love to buy that?
Yeah.
So who's selling it? People that are selling it are uninformed, or why would they be selling it?
Yeah, knowledge is power, and that's what we've got with this process. Well, listen, thank you so much for taking the time and just doing a quick overview on that, because I know clients are going to be seeing the security in their portfolio, and they're probably going to be wondering, I wonder why we got that. And so now we've just done that had that discussion and put it on a recording, so everybody will know exactly what the rationale was and why it's all of a sudden showing up in their portfolio, and it's because of the process. So thanks so much for taking the time and going through that, and I always look forward to our calls.
Great, Scott. Talk to you later.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.